Where's the U.S. stock market headed? March 2025. Since the 80s, U.S. stocks rode cheap money and globalization to sky-high valuations. But could 2025 end that golden era? Let's dive in. I've tracked trends like the Fed funds rate, CPI, Wilshire to GDP, SPPE, and Berkshire's cash pile. Here's the story. Why valuations soared since the 80s? PE ratios jumped from single digits to 25, 30 plus. Wilshire to GDP hit 180% in 2021. 3 drivers. 1. Globalization boosted profits. 2. Rates fell from 19% in 81 to near zero post-2008. 3. Fed liquidity turned crashes, 87, 2008, 2020, into short bears, long bulls. Think 2020's V-shaped bounce. But that era's fading. The shift: debt, inflation, Fed limits. By March 2025, the Fed's cut rates 100 points in September 24, 5.25% to 4.25%. Inflation's back at 4 to 5%, yields rising to 4.5%. What? Debt: national debt to GDP over 120%, corporate at $12t. High rates risk defaults. Reinflation: early cuts sparked price spikes, breaking the 80s low-rate mold. Signals: yields up despite cuts show distrust. 2025-2027 risks. Liquidity dries up, less cash, fewer buybacks. Economy weakens, growth under 1%, earnings flat. Tariffs: 25% on Canada, Mexico, 10% on China cut GDP 0.5 to 1.5%, lift inflation 1%. Valuation hit. PE could drop from 25 to 30 to 15 to 18. From 5,000, that's 3,500 to 4,000 by 2027, a 20 to 30% fall. Systemic risk unloads. Why 2025? Debt costs soar, tariffs bite, liquidity cracks. High valuations could end by 26, 27. What's next? The Fed might adapt, but data, yields, inflation, debt, says the party's winding down. What tips it? Tariffs, debt? Tell me below.